Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, tax strategist, here to help you turn taxes from a headache into a competitive advantage. Today's episode, tax strategies for diversifying your investment portfolio, how to balance risk, preserve savings, and legally minimize what you pay. We'll cover tax character across assets, smart asset location, fund selection, municipal and international nuances, harvesting and rebalancing, retirement withdrawals, charitable strategies, real estate tools, opportunity zones, annuities, state quirks, business owner tactics, and 2 case studies. Think of this as your after-tax return boot camp, minus the push-ups and with better coffee. Enjoy responsibly. Diversification spreads risk, so no single holding or sector dictates your future. Taxes add texture to that risk. Stocks can pay qualified dividends and produce long-term capital gains at preferential rates. Short-term gains and non-qualified dividends hit ordinary brackets. Bonds pay interest taxed as ordinary income. REITs distribute mostly ordinary income, with potential qualified REIT dividends under 199A. MLPs pass through income, losses, and depreciation via K1s. Direct real estate layers in depreciation, capital gains, and potential recapture. Understanding the tax character of each return stream helps you set allocation targets and choose the right accounts for each piece, wisely. Asset location places investments in accounts that minimize tax drag without changing your overall allocation. Generally, park tax inefficient assets, taxable bonds, REITs, high turnover active funds, inside tax deferred or Roth accounts, hold tax efficient equities, broad index funds, ETFs, and long-term individual stocks in taxable accounts to capture qualified dividends and manage capital gains timing. HSAs are stealth Roths for healthcare, so favor long-term growth there. Revisit location after major life events, new accounts, or rate changes. Location complements, not replaces. Allocation. Risk targets still drive the bus, while location quietly upgrades miles per gallon on your after-tax return journey. Small moves compound into meaningful savings. Fund selection matters. Favor low-cost index funds and ETFs with low turnover. Fewer trades usually mean fewer taxable distributions. For mutual funds, review distribution history and embedded gains before buying, especially near year-end. ETFs often use in-kind redemptions to limit capital gains, but not all are equal, so check prospectuses and prior payouts. In taxable accounts, be skeptical of frenetic active strategies. They must outperform by more than taxes and fees. Pair core total market exposure with targeted tilts as needed, and use specific lot accounting to control realized gains when trimming positions or rebalancing. Stay mindful of wash sale risks around substitutions. Municipal bonds can shine for high earners. Interest is federally tax exempt, and in-state issues may avoid state tax too. Compare tax equivalent yields to similar risk taxable bonds, watch credit quality, and note AMT exposed private activity bonds. Munis belong in taxable accounts. Placing them in IRAs wastes the exemption. International equity funds often withhold foreign taxes on dividends. In taxable accounts, you may claim the foreign tax credit, boosting after-tax yield. That credit is generally lost inside IRAs and 401ks, nudging some international exposure toward taxable when allocation and simplicity still align. Don't chase credits if they complicate rebalancing or paperwork. Keep perspective. A flexible plan uses multiple account types. Taxable brokerage offers liquidity, favorable long-term capital gains, and potential step-up in basis at death. Traditional IRAs and 401ks give upfront deductions but create future ordinary income and required minimum distributions. Roth IRAs and 401ks trade deductions for tax-free growth and withdrawals, great for high-growth assets. Health savings accounts are triple tax advantaged if used for qualified expenses. Invest them prudently. The right mix gives you levers to time income, control brackets, and manage the 3.8% NIIT. Diversify your tax buckets like you diversify your holdings. Flexibility beats precision forecasts every single time. Seriously. Small business owners can supercharge savings with plan design. A solo 401k combines employee deferrals with profit sharing and often beats a SEP at modest incomes. Layer a cash balance or defined benefit plan to push deductible contributions into six figures, subject to age, income, and actuarial constraints. Coordinate W-2 versus pass-through income, spouse employment, and controlled group rules. Fund pre-tax to reduce current liability and direct higher growth assets to Roth subaccounts when available. Align contributions with quarterly estimates and cash flow, avoiding April surprises. The right combo slashes taxes today and reduces future RMD pressure. Documentation keeps auditors pleasantly bored. Roth wins when your current marginal rate is lower than or comparable to your future rate. Backdoor Roth IRAs help high earners, but pro-rata rules apply if you hold pre-tax IRA balances. The mega backdoor uses after-tax 401k contributions with in-plan Roth conversions or rollouts. Consider partial Roth conversions in early retirement or low-income years, watching NIIT, ACA subsidy cliffs, and Medicare IRMA brackets. Place the highest growth assets in Roth to maximize tax-free compounding. Run multi-year projections. Sometimes paying tax now reduces lifetime tax and future RMDs significantly. Coordination with Social Security timing often enhances conversion windows. Plan, monitor, adapt. Tax loss harvesting turns volatility into a deduction by realizing losses to offset gains and up to $3,000 of ordinary income, with excess carried forward. Avoid wash sales by not rebuying substantially identical securities within 30 days before or after the sale across all accounts, including IRAs. Use pre-selected replacement funds to maintain market exposure. Tax gain harvesting can be powerful in the 0% long-term capital gains bracket, often for retirees or years with business losses. Reset basis while staying diversified and coordinate with credits, deductions, and bracket management. Document trades, rationale, and replacement holdings for future reference. Stay disciplined. Rebalance with taxes in mind. Use new cash, dividends, and interest first, then sell in tax-advantaged accounts. In taxable accounts, prefer long-term lots and specific lot identification to control gains. Avoid buying mutual funds right before capital gains distributions. Withdrawal sequencing often starts with taxable, then tax-deferred, then Roth, but bend rules if pre-RMD conversions reduce future brackets. Consider NIIT, IRMA, and state thresholds. Set policy bands to reduce emotion. Say, rebalance when allocations drift 5%. A written policy keeps you steady when markets wobble and headlines scream. Consistent process beats seat-of-the-pants heroics every market cycle. Simple rules prevent costly detours. Charitable giving can amplify impact and reduce tax. Donate appreciated securities held more than a year to avoid capital gains and deduct fair market value if you itemize. Bunch several years of gifts into 1 year with a donor-advised fund, then grant over time. In retirement, qualified charitable distributions from IRAs, up to $100,000 annually, can satisfy RMDs and exclude the amount from income, potentially lowering NIIT and IRMA. Coordinate giving with harvesting, Roth conversions, and state rules, and document contemporaneous acknowledgments to protect deductions. Charitable bunching pairs well with high-income years or liquidity events. Plan, pledge, then execute. Real estate offers distinct levers. Depreciation can shelter rental income, though passive loss rules may limit use unless you meet material participation or real estate professional standards. Suspended losses carry forward to offset future income or exit gains. Cost segregation accelerates depreciation, front-loading deductions. Expect potential recapture later. A 1031 exchange defers gains by reinvesting in like-kind property under strict timelines, with basis carrying forward. REITs provide diversification and liquidity but are tax inefficient in taxable accounts. Place them in IRAs when possible. Match property, syndications, or REITs to your liquidity, expertise, and risk tolerance. Stress test assumptions and vacancy buffers. Always. Opportunity zones allow deferral of eligible capital gains by investing through a qualified opportunity fund within 180 days. Tax on the original gain is due by December 31, 2026 or earlier exit. Hold 10 years, and appreciation inside the fund can be tax-free. Evaluate project risk carefully. Annuities offer tax deferral, but withdrawals or ordinary income and fees matter. Prefer low-cost, no-commission options. State taxes can flip conclusions. Some tax capital gains heavily or exempt retirement income. Align munis, withdrawals, and conversions with your state's rules before executing. Residency planning near retirement can unlock substantial multi-year savings. Model scenarios. QBI under Section 199A can deduct up to 20% of qualified pass-through income subject to wage and property tests and phase-outs. For S-Corp, reasonable compensation affects QBI. Strike a defensible balance. Case Study 1, a 45-year-old consultant earns $600,000. We implement a solo 401k plus cash balance plan, targeting over $200,000 in deductions. Roth subaccounts hold equities, pre-tax buckets hold bonds, taxable holds broad ETFs and in-state munis. Loss harvesting builds carry forwards. Calibrated wages optimize QBI. Quarterly estimates reflect contributions. Outcome: materially lower current tax and reduced future RMD pressure. Documentation and minutes reinforce compliance. Case Study 2, a 61-year-old couple retiring at 64. We hold 2 years spending in bonds and cash, emphasize equities in taxable and Roth, bonds and pre-tax, and spread Roth conversions to the 24% bracket before RMDs. We harvest gains in 0% years and monitor IRMA. Planning calendar. Set savings early, review mid-year, finalize conversions and distributions in fall, harvest and bunch deductions at year-end. Pitfalls, wash sales, embedded gains, MLPs and IRAs, chasing tax breaks over risk. Action steps: inventory accounts, map asset location, set rebalancing bands, build a harvesting playbook. Thanks for listening. Work with a qualified planner.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.